Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. We have a massive episode today. I used massive twice there. Anyway, my name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. I'm very excited for this episode. It is the 12th of September as we release, and you know what that means. It means we are halfway through Super September.
Yep.
How's your September going?
Broadly, it's going well.
Now, we should say that as we push more and more into YouTube, we have more of an international following. And there were a few questions, what is super? So we should just be clear that tax advantage retirement savings account September doesn't roll off the tongue as well. But superannuation is our 401k if you're listening in America, or lifetime ISA if you're listening in the UK.
Yeah.
Canada has something else like an RSPA or something. I don't know. Canada, you know what you've got.
Yeah, I know the girls who run The Curve,
Yes.
Vic and Soph, they call super the 20-year holiday fund. To give a bit more...
That's good. I like that.
To give a bit more realism to it, I guess.
Yeah, but as we get into this episode, a reminder to check your super, the fees that you're paying, the settings that you've got it on, and if you've got any duplicates. That's what we're doing this September. Yeah. But let's get into today's episode. We normally start with news, but we're actually going to take aim at a news organisation in a little twist to kick things off. We're bringing back Investor Confessions, and then we're going to introduce a new segment, What Makes It Great.
Yeah, feels like September is the month of new segments here at Equity Mates as well as super. Now, let's start with not financial advice.
This is not financial advice.
This segment is where we celebrate some of the worst financial advice going. It's off the back of our weekly wrap on Instagram, so make sure you're following us on Instagram. And today, we are taking aim at 60 Minutes.
Yes, we normally look at social media, but this is one of the biggest news shows on one of the biggest TV networks here in Australia.
Yeah.
I would say that most hard journalism has left the building at our commercial TV networks, 7, 9 and 10. Except for the news bulletins, you don't get a lot of like long form reporting, except for a show like 60 Minutes. Is that fair to say?
That's fair to say, yeah.
Okay.
Yeah, I'm not sure. Look, I don't watch a lot of 60 Minutes because I don't necessarily see it as the hard-hitting journalism that I'm after.
No, I'm not saying it's hard-hitting journalism. I'm saying it's commercial TV's version of hard-hitting journalism.
Yes, correct. Yeah.
Well, we were certainly hit hard when we saw the journalism that they brought on a couple of weeks ago. They brought a commentator from the US, an economist, Harry Dent Jr., to talk about the Aussie housing market. And rather than us summarising what he said, we're going to play a clip that we think is worth listening to. It's about 2.5 minutes, but just trust us, it's worth listening to.
Owning a home has become out of reach for many Australians. Which brings us to another problem. House prices are too high in Australia. US economic commentator Harry Dent says it's a worldwide issue that's been years in the making.
The greatest boom in history was from 1983 to 2007. Natural boom. All since 2008, all the stock markets since then around the world, and especially, it's all been totally artificial, totally funded by stimulus, which is not sustainable and is basically just not good. Having that much stimulus in the economy is like taking a powerful drug. It cannot work out well. You got to detox it at some point. That's what this is, a worldwide detox of debt and real estate and financial asset bubble.
For Australia, Harry has grim news. He warns house prices will plummet.
If you buy a house now, I am predicting you could lose as much as 50%, give or take, in the coming years.
Are you truly saying that people's homes are going to fall by 50%, half the amount they're worth today?
U.S. already fell. Average home 34% in the last downturn, and 50% for upscale homes. And people said that couldn't happen. Okay, this is a bigger bubble.
When is this crash going to happen?
I think it's going to start in the second half of 2024 in the U.S. and spread. I think the U.S. is going to start a recession that spreads around the world because this is a global phenomenon, especially the real estate bubble. It's everywhere.
It's a dilemma made even more complicated in Australia because houses are in such short supply.
For a young person, I mean, my advice is very simple. If you have not bought your first home yet, do not.
And for those who do have a home, if they can, Harry reckons they should sell now, at the top of the market.
If you sell now, you're going to be ahead of the crowd. And then when things go down, you're going to be able to buy at least twice the home for the same price and mortgage. That's the bonus.
Two things for me here.
And let's remember that this is hard-hitting journalism on a flagship news show on Australian TV.
Firstly, I'm pretty sure we've done some of his stuff before on our Not Financial Advice. Yeah, because he writes a lot. He's a newsletter writer. Overseas, US commentator. Look, this is not a storyline that is new news. I remember 2017, 2018, people were talking about a crash. 2020, people were talking about a crash. This is not new news, but for me, this is just someone who wants to get some headlines, and nothing hits Australians more emotionally than telling them the houses are going to crash.
Yes.
Full stop.
Yeah.
I think where we should go from here, Ren, though, is this isn't the first time he's said something like this.
Yes. Now, we should give a hat tip to the ABC's Media Watch for pulling these clips together because we've pulled them from their research. But Harry Dent has a history of doing this. So that was him in 2024 on 60 Minutes. Here's him in 2023, also on Channel 9's Today Show.
One outspoken US economist is predicting the biggest market crash in our lifetime. Yay. Harry, morning to you. That's quite a frightening prediction you've made. Walk us through what you expect will happen.
Or how about this, also on Channel 9 from 2022.
Is now a time for people to be buying property if they're looking first-home buyers?
No, you have to wait another couple of years. I'm seeing property prices are going to go down 40 to 50%.
So he made the same call 2 years ago.
Yes.
In which house prices around Australia have gone 50% the other way in some markets.
Yeah, true. But look, this isn't a new prediction from Harry Dent. And so far we've just targeted Channel 9. But they are not alone in getting the alarmist economist on to generate headlines. How's this from 2011 on Channel 7 Sunrise?
If you're a young couple, do not buy a house if you're getting married for another 3 years and let the crash happen and then this greatest sale in history. I mean, who doesn't like a sale? Imagine buying stocks and real estate 50, 60, 70% lower.
I mean, he's right there. Who doesn't love a sale? But look, so he's been pushing this story for almost 15 years now.
Yes, but just 2011.
Yeah.
Since 2011, house prices have doubled.
Yeah.
More than doubled in some cases.
Bad financial advice.
Terrible financial advice.
Yeah.
Irresponsible programming from the 7 and 9 people who continue to platform this guy. And just like the idea that Australian housing is going to fall 50% by next year. Stupid.
Yeah. Well, I think time and time again we've had proper experts on the show who have put clear argument as to why supply and demand and many factors are going into a sustained house price growth.
It is true that the government has overprinted money and that there's a looming debt crisis at some point. It is true that Australian property is a bubble. But that isn't enough to talk about the structural drivers of house price growth and what is going to change those.
Well, the sad thing is, or maybe the unfortunate thing is, there may have been a number of people watching there who unfortunately take advice from Mr. Dent. Is it Dent? Yes.
Yeah, Dent. It's just like, imagine if you were a couple that were watching watching Sunrise in 2011 and you didn't buy because you heard that.
Yeah. And then you heard him again in 2022, 2023 and 2024.
Yeah. But your savings rate can't keep up with the rate of house price growth over the last 10 years. It's obviously we do this segment to celebrate poor financial advice, but it's also just like, come on, do better. Yeah.
Well, no doubt that he'll make an appearance on one of the networks in 2025, at which point I'm sure there also won't have been a crash of 50%. He's going to be right at what's the saying?
Broken clock is right twice a day.
Broken clock's right twice a day. He may be right at some point to the tune of 50%, who knows? But yes, buyer beware when listening to people like him.
Yes.
In the confession booth, everything is anonymous.
Off the back of a successful launch of Investor Confessions a few episodes ago, we have more Investor Confessions this time round.
As you said, it's new segment September. We're trying some new things here. And this was one that we had a lot of fun with. We got some confessions from the community, and these can be anonymous, they don't have to be, but the idea is that everyone makes mistakes as an investor, and so much of financial media celebrates people's successes. A lot of financial social media lies about people's successes, but here on Equity Mates, we want to celebrate the mistakes because we all make them. Whether you're a billionaire or just getting started, everyone has things that they can get better on. And this is the safe space where you can make your confession.
That's it. We had a number of confessions last segment where our community members stepped into the confession booth. You kicked it off with one of yours. And so this is a safe space for you to do it. Come and join. We have a couple today who have been submitted from the community. So thank you for those that have. Head to equitymates.com/contact. You'll find all the information there to leave a confession. As we said, it is anonymous, and I reckon let's get stuck into it.
All right, so we've got a voice note and then we've got a written confession. So let's start with the voice note.
Hey Bryce, hey Ren, love the show. Now my community confession starts way back when my investing journey began, actually, which is around 4 years ago. And at the same time, I also became vegan. I went vegan 4 years ago and just thought that a lot of plant-based companies were going to be the future. And that's where my investing thesis started. I did my research and opened up a brokerage platform and ended up dipping my toe in the investing world with the company Oatly, thinking that was going to be a winner. Now, at the time of sending this memo, that investment is down 91%. So from there, that single investment totally scared me off from single stock investing again. And I basically haven't opened that brokerage platform again. I opened a brand new account on a new platform, and I've only ever since invested in ETFs. I've got 2 core ETFs, dollar cost average into, and my version of fun investing now is not into single stocks, but general thematics that I sort of believe in, and that's how I kind of look at the risque side of investing now, is through themed ETFs as opposed to single stocks. So thanks to Oatly for my journey and how I got to.
Love it. What a confession. What a confession. Thank you for bringing that to the confession booth. A couple of things for me. Look, love the fact that your investing journey started with investing in what you knew. There's nothing wrong with that. I think that's a great place to start. The investing journey is reminiscent in some way of yours, Ren, where the first investment ended up being one where you lost a lot of money. I'm looking at Oatly now, and it feels like this community member bought at the peak. If it was 4 years ago, it is down 96%. So that's tough. But I think pivoting, not giving up on the investing journey and pivoting is the important thing here.
Can I just say, starting a new brokerage account, kind of genius?
Yeah,
Like, I pay that.
Just get out of sight, out of mind.
Like, there was a world where you could have just sold the stock, claimed the capital loss as a tax benefit for future capital gains, but you said, no. Burn the ships, I'm starting again. I don't mind that. Look, the whole vegan thematic really had a moment in like 2021, because it's not just Oatly that's down over 90%. Beyond Meat is also down over 90%. So that's been tough, but I love the fact that one, you stuck with it and you started again, and two, that you were willing to come and confess.
Absolutely. Thank you for that. Keep the confessions coming, equitymates.com/contact. Now, the second...
we should say, you probably should sell it and claim the tax benefit.
Yeah, well, not financial advice. Now, the second one was written in, so we've brought our producer Soph in to read it. Soph? Hello. Just like last segment, you did an excellent job at reading them, so take it away.
Well, this one is a little bit confronting, so just hold on to your boots. Hi guys, I love the concept of investor confessions, so I wanted to share something to get it off my chest.
Juicy.
But please keep me anonymous. That's why I've written in rather than sending a voice note. So you get to be voiced by me. Congratulations. About 6 months ago, my fiancé and I combined our finances. We had a joint spending account for a while, but after getting engaged, we decided to go further and combine our salaries into one bank account to do everything together, pay off our mortgage, spend, save, and invest. But rather than updating our bank details with work, we agreed to just transfer our full salaries into this new shared bank account and then manage our money together from there. Now, in the past few months, I've had a realisation about my fiancé. He is a shit investor. He's great with the money basics, don't get me wrong, spending less than he earns, investing the difference. But what he invests in is crap. Individual companies he doesn't know anything about, speckies he's heard from his mates or on a podcast. I wonder what podcast that could be. And when I call him out on it, he gets defensive, and it absolutely does my head in. So here's my confession. I recently got a pay rise at work, but decided not to tell him. Instead, I just keep transferring the same amount of money into our joint account that I was and have been pocketing the difference. Right now, it's sitting in a high-interest savings account, earning about 5%. I'm thinking about transferring it to a broker and investing it. I feel a bit guilty about not telling him, but I would do it again. I'm not really looking for advice. I feel pretty good about it. I just want to get the story off my chest and wanted to tell someone about my secrets. Again, please keep me anonymous.
Wow, juicy stuff. Thank you for stepping into the Investor Confessions booth. Certainly a juicy one here.
Yes.
Wow.
Yeah. Honestly, fair play.
Fair play.
Yeah, I don't know about this one. I feel like this might be a bit more of a needing some honesty in your relationship rather than an investing decision. I don't know. What do you guys think?
If the agreement is that you're transferring salary, that's the agreement.
Sure. Yeah. No,
or just sit him down and be like, you're a shit investor.
Oh, it sounds like she has.
True.
When I call him out on it, he gets defensive.
True. Or maybe just, if you start investing if she starts investing and shows that she's a better investor and then present the information that, hey, I'm actually better at this than you, maybe let's think about this.
Yeah.
Then that could work.
Could work.
Yeah.
I mean,
tough if he's defensive about it, though.
Sounds like they're not looking for advice. It sounds like
he just wants to get it off her chest.
I just want to let you know I'm doing this because it's kind of semi-eating me alive. But so fair play.
Fair play.
I'm just a big believer in everyone having their own pocket of money, even if you're joint. I don't think anyone should ever go full 100% joint. I think each person should have an emergency fund separate.
So personally, the way we do it with Harriet and I is rather than transferring salaries together and then starting from there. It's a transfer of a predefined amount into everything joined, and then you have, if that makes sense.
Yeah, then you have leftover.
And then, that's your runaway fund or whatever you like to call it.
Yeah.
Having your own money.
Yeah.
And joint, obviously, to do bits and pieces. But you never know.
All right. Well, look, we love that confession. If you want to confess anything, it doesn't have to be as juicy as that. It can be...
We want juicier.
Well, I mean, if you've got a juicy confession,
True.
please bring it in. But yeah, look, this is a safe space to share what is on your mind or the mistakes that you're trying to work through. So hit us up. Link is in the show notes if you want to join in.
We're going to take a quick break, and on the other side, a new segment again. New segment September. It's called What Makes It Great, and we're unpacking Nvidia. We'll be right back. Welcome back to Equity Mates. This segment is called What Makes It Great.
Yes, we have spoken about a lot of great companies over the journey, and in this segment we really, I guess, want to understand what it is that makes them so good. Yeah. This, it could be that they have a great management team. It could be that they have a great competitive advantage. Whatever it is, we want to try and understand it, because chances are if we can identify it in these great companies, we can start to identify it in other companies that we might want to invest in.
Yes, because per Mark Twain's quote, history doesn't repeat itself, but it often rhymes.
Yeah, in this case, you could say something similar for great companies. They never look exactly the same, but they share similar features.
Yes, so there's been plenty discussed about the financial results of Nvidia, but we don't often discuss as much the factors that have led to such financial success and share market returns, and what has really driven this company to greatness, or at least well on its way.
Let's start by establishing how great it is for people that are not familiar with Nvidia. So, it has more than a 70% market share in AI chip sales, despite competing with Google, Amazon, Meta, IBM, and others. Share price up more than 1,000% since October 2022. We shared this on our social media last week. 76% of employees are millionaires now. 1 in 3 are worth more than $20 million.
And let's put that in absolute numbers, though. 76% of 3,000 employees.
No, 30,000.
Sorry, 30,000. 30,000.
Yeah, that is the power of an employee share scheme.
That is nuts.
Nvidia has a $3 trillion market cap. It is up there with Apple and Microsoft. They're the only companies that have reached that mark. It has profit margins above 50%. And this was a quote from an analyst that we thought really exemplified just how great Nvidia is. Customers will wait 18 months to buy an Nvidia system rather than buy an available off-the-shelf chip from either a startup or another competitor. That is how dominant it is in this space.
Yeah. But a reminder that this chip maker doesn't even make its own chips. It uses TSMC to actually do the manufacturing. So let's unpack what actually makes this company great.
Yeah. What you just said is like brushed over a little bit. Like it doesn't even make its own chips. Yeah.
A lot of reliance on TSMC.
Well, I mean, if you invested in TSMC or if you invested in ASML, the Dutch lithography player that is a monopoly and a crucial supplier to TSMC, you would have done very well with both of those companies as well.
Yes.
Yeah.
But
that's not what we're talking about today. We're talking about Nvidia. So what makes it great? We've kind of pulled out 4 key features, things that sort of really set Nvidia up, I guess, are things that we should be looking for with other businesses. So the first, and this is one that we hear a lot from expert investors, is that it's founder-led. Now, Jensen Huang he's been the head of the company, co-founded it, been the head of the company for 31 years now. Founded in 1993. And just the best.
Yes.
Incredibly dedicated. Yeah, amazing.
Expects a lot from his workers. He's a headline act, well known for wearing a black leather jacket.
Yes, yeah. There was a like a serious strand of social media that was speculating, because in a recent interview he wasn't wearing a leather jacket, and people were trying to figure out what that meant. And it's like, come on guys, we've gone too far here. He also has the best LinkedIn in the game. His LinkedIn has 2 jobs.
Yeah.
Dishwasher, busboy and waiter at Denny's for 5 years, and then Nvidia founder and CEO
for 31 years. Yeah. Now look, that's his LinkedIn game isn't the reason it's such a successful company, but I think that there are examples time and time again, and also experts come on the show time and time again that often show the relationship between a founder-led business and its performance. And it not only drives a lot of interest from an investor standpoint, but when you have someone like Jensen leading for 31 years with such passion and I guess a clear idea on where this company needs to go, then the results speak for themselves.
And the reasons that it makes sense, like one, founder-led companies, like the founder to found the company in the first place had a vision and was willing to take risks and was entrepreneurial, and like that continues as they continue to lead the business. Secondly, like they're truly long-term thinkers about this. Like they've dedicated their lives often to build these businesses. So they're thinking long-term and they're trying to forecast where the world is going long-term. And then thirdly, like their whole net wealth, or like the majority of their personal finances, are tied up in the success of the company. So like their incentives are truly aligned with shareholders. And you compare that to like the managerial class of CEOs, there's nothing wrong with them, but those 3 incentives there aren't there. Like they're not as entrepreneurial, they're much more like managerial. They just want things to be ordered for their short stint as leading a company. They're not long-term thinkers, because the average tenure of a managerial CEO is like, I don't know, 3 to 4 years, and their personal net wealth isn't tied up in this one company in the same way, so their incentives aren't as aligned. So when we're looking at what makes great companies, when we're looking at other companies being founder-led, that's a big one to look at.
And he's worth $104 billion, so kudos to him. And that leads to the second point, which is they've really led like a step change in technology in this sector. So they're well known for obviously their GPUs and microprocessors. And so while standard microprocessors excel at performing complex calculations sequentially, Nvidia have been able to develop chips and GPUs that do many tasks all at once. And this is where they've really come to the fore.
And we should be clear, like the first GPU came out in 1999, like the application of this technology wasn't clear when it was developed. The takeaway here is that if you had recognized that there was a step change in the technology, like that's a hallmark that this could be something in the future.
Well, a bit of jargon, GPU being a graphics processing unit, FYI. Leads to our third point, which is they were early, Ren, when it came to identifying what now seems obvious, and it's here and it's dominating AI. But they didn't start out like that. Started in the video game.
They started in video games. That was how Nvidia became a thing. But really, if you go back to 2012, researchers used GPUs to achieve human-like accuracy in tasks such as recognizing a cat in an image. Now, if you just pause there and you think, okay, you know, like this GPU can now do a recapture, point out all the crosswalks on the photos as well as a human can. Like that doesn't seem like a monumental breakthrough, but obviously we're not as close to all this as
we don't run Nvidia.
As Nvidia are, but for them, they realized what it meant, and they turned every aspect of their company to advance the new field. That's a quote from Jensen recently. They spent more than $30 billion in a decade. They became integral to this AI revolution. And so, you know, if we start to look at the ingredients, and obviously hindsight is 2020, but like if we see a founder-led business that had an early technological breakthrough and then sees something and starts dedicating all of their resources and all of their focus towards this new application of their technology in an era where all of the other major technology players didn't see it, all of the big tech companies didn't see it, you start to see, okay, there's like a different view of the world emerging here.
It's reminiscent of Zuckerberg going hard on metaverse, though.
It is. I mean,
he did pull the pin on that.
That's a bad example of, but a good example of it is when Zuckerberg absolutely internally disrupted Facebook as it was then, and said mobile is the focus in 2008. The iPhone had only been released in 2007. This was an early bet, and it was a company-making bet for Facebook at the time.
Absolutely.
So it is, yeah.
And then the final point is it's community driven. And what we mean by that is everyone is so reliant on this company.
Yeah. Well, not even everyone's so reliant on the company. Everyone builds on Nvidia first. So when we speak to professional investors, they'll often say what they do to research a company is they speak to management, which we can't really do as retail investors, but they'll also do channel checks. So like, what do suppliers think of the company? What do customers think of the company? What do competitors think of the company? And I think if you did channel checks on Nvidia now, but 5 years ago when AI was starting to emerge as well, everyone built on Nvidia first. And like, that is a hallmark that like the people that are closest to the technology have a clear preference in terms of what technology is the best.
Yeah.
And like that's become like a self-reinforcing cycle, because the more people that build on Nvidia technology, the more applications there are for Nvidia technology, the more use cases that emerge for its technology, which then increases demand for that technology.
Love it. So 4 key takeaways there for Nvidia and what makes it great. There are plenty more, but this company's going to be around for a while. Let's put it that way.
So the question then is really like, how do you find the next one? And that's the hardest thing with investing. And it's easy for us to look in hindsight at a great company and say, here's what made it great. The hard thing is then to do all the work, to trudge through all the companies that are out there and try and identify it again. But I think the point of this segment and what we want to do as investors is just continue to internalize these lessons about what makes great companies, because naturally then when we see the next one, hopefully we've learnt the lessons from the previous one.
If you have a company that you would like us to have a look at and understand what makes it great, head to equitymates.com/contact. There's the ability for you to leave that there, or hit us up on our Instagram DMs. We'll make sure we pick it up. Ren, that brings us to the end of today's show. If you enjoy or take value from the show, we would really appreciate if you could leave a rating and a review in your podcast app. It helps us get in front of new equity mates and help them on their investing journey. Similarly, if you want to leave an investor confession, a reminder, you can head to equitymates.com/contact. Leave the confession. It can be anonymous. As you heard, we can get Soph to read it out, or we'd love to get a voice note from you. Great to chat stocks and markets, Ren. We'll pick it up next episode.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.